Okay, we're officially ready to get started. And some of you may or may not notice, but Greg Stanek is with us in person this week because of popular request last week. So very exciting stuff. Anyway, getting started this week. These are our thoughts. We actually started these calls on March 18th. And prior to that, we'd never done a group client conference call before. That makes this our 6th week of doing these, our 6th conference call. And one of the interesting things in reflecting back over the past 5 weeks, 6 conference calls between now and March 18th, or since March 18th, is that at that point in time, what we were really talking about is how long this would last. And this meaning the economic shutdown that we're in. And the conversation that we were having then, a mere month ago, was would this last 2 weeks, 4 weeks, or 8 weeks? And a lot of, and we thought 8 weeks seemed crazy. Where we are now is we know it's lasting 8 weeks, and we know it's going to last longer than 8 weeks. And even as the economy starts to reopen, that's going to be slow. So a huge part of this economic shutdown will in fact be longer than 8 weeks. And that influences our thought processes, it influences the companies that we invest in, it influences our decision making. So that's changed from when we did the first call. 6 weeks ago, or sorry, 5 weeks ago, six conference calls ago, when we were first doing these, it was a crazy concept, and the national conversation was, we can't shut down the economy. That's impossible. We can't do that. Here we are, and now kind of the opposite is going on, which is, are we ready to reopen? Maybe we shouldn't reopen, and that being the scary conversation this time around. As Winston Churchill said, we are now at the end of the beginning. So I think that's probably where we are. Actually, Jana gave me that to say. So there's been a ton of news this week, and we're going to do it in this order this week. We're going to go to news because there's a lot of stuff happening, and then we're going to get into the portfolio. So I think the most momentous thing that happened this week, or maybe since we spoke last week, the most momentous thing has been the turmoil that we've seen in the oil market. And I am very clear on saying the oil market, not the energy market, not the natural gas market, but oil specifically. What we saw on Monday was that the price of oil traded down to negative $40 a barrel. What that was a trading dislocation based on futures contracts and the ability to physically deliver oil to the person holding the futures contract. There are all these people, I mean, mostly professionals, but individuals too, who just trade oil futures. And they don't expect to actually receive delivery of the oil. They think that they can just get out on the day of options expiration. But there was a lot of dislocation this time. And there is a storage constraint here in the US. And so that dislocated the oil market. What's very interesting to note is that despite that, and despite the incredible news that it elicited, despite all the headline grabbing, the MLP indexes, or midstream energy indexes, and that's what we have most of our energy invested in, are the pipeline companies. Actually, those indexes are up, and our holdings are up this week. In fact, they're up, this is as of last night, but they were up 1% on the week. In fact, the energy index is down 5% this week. Again, as of last night, things are changing a little today. And believe it or not, technology is down 6%. And I highlight that to remind you that there's a disconnect between what we saw in the oil headlines this week, the broader energy markets, and what it really means. That being said, I don't want to leave out the fact that oil prices now that this dislocation is coming to a conclusion, oil prices now are at levels that last were seen in the late 1990s. They are really distressed. The flip side of that for our portfolio is that natural gas prices are actually up 20% since the beginning of April. And if you look at a lot of the companies that we're invested in, Magellan Midstream, Williams Companies, ONEOK, Energy Transfer Partners, most of what they do, in fact, in the case of ONEOK, all of what they do is transport natural gas. So while they get drawn into the headlines of energy, they're not necessarily exposed or related to the headlines that you saw this week. Okay, I might have belabored that. One other thing of note, since we spoke last week, our holdings in the major integrated energy companies like Chevron in the US dividend portfolio, Total and Royal Dutch in the international portfolio, they're actually all up since last week. Not a lot, a couple percent, but they're up. So please don't be too upset or jarred from what you've seen in the headlines. Other things that started to happen this week is we started to see real earnings come in. This started last week, at the end of last week, and then is picking up steam as companies are reporting their quarterly earnings. And this is really useful for us because it's the first real look that we're getting at what's gone on over the past quarter And even though everyone that we've heard is suspending guidance, we can't look into the future, blah, 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 things are dislocated. The reality is that we are getting some insight into what companies are seeing, how they're planning, what they're thinking about, and we're able to contrast and compare who's faring better and who's faring worse. That's been helpful. Last Friday, this was a big piece of news that came out too. Gilead's remdesivir, I'm saying it wrong. Remdesivir, thank you. And once you say it wrong, you can't say it right. Gilead's remdesivir drug showed really, really positive data in clinical trials, and the stock market was up a ton on Friday. So we had that move contrasted with Monday and Tuesday of this week, where the stock market was down a ton because of oil prices. And I highlight that to show you the magnitude of forces that are at work, and sometimes conflicting forces that are at work. While things have quieted down, we haven't had any of these limit down or limit up days. We still have huge volatility by historic standards, although it is getting better, and it's certainly at least feeling to Greg and I like we can get our arms around it, and we know where prices are kind of starting to set themselves, and we're starting to get a little bit more clarity. Greg, you want to get into more news from this week?
Yeah, there was a lot of news in the past week. It was a busy week. I think last week I was complaining to Jenny that there's probably not enough news to cover on a weekly conference call, and then this week happened. So yesterday, the big news on the policy front, the unprecedented policy response is continuing. The Senate passed a $484 billion spending package, which targets small businesses, hospitals, and more testing. The House is going to try to approve this by tomorrow. And now this is on top of the $2.2 trillion that was already passed way back on March 27th, only 4 weeks ago. So it's a lot of policy response. In addition to that, the Fed continues to buy every week. I think they bought $200 billion of securities in the past week. They've added $2 trillion to their balance sheet in the last 5 weeks. So there's a lot of policy coming at the trying to offset the slowdown in the economy. As Jenny mentioned last week, on Thursday, there was positive news from Gilead on remdesivir. Actually, the news came from the University of Chicago, which was conducting they were part of a phase 3 trial study on remdesivir. They have 125 patients who were seriously ill with COVID, and they're reporting it's anecdotal evidence. They didn't release the hard data on it, but that within a day of receiving treatment, some patients were immediately coming off respirators. Fevers were going down almost immediately when receiving the drug. A lot of was supposed to be a 10-day course of the medication. Most were discharged before the 10 days. I think they had 2 deaths in the study. The issue with the study is that there is no control group in this part of the study. So it's tough to compare. Is this better than no drug? But I think the conductors of the study were so excited by the results that they thought the need to present it around the University of Chicago that there is hope. This is the second positive set of news on remdesivir. That was out a week before in a compassionate care use study. There were positive results as well. With again very seriously ill patients having positive results following the taking of this drug. So it's encouraging. Gilead says they have capacity. They'll have capacity to treat 500,000 patients by October, and they would have capacity to treat 1 million patients by the end of the year. So they're ramping up manufacturing even before they get approval. And I would also point out that this is not the only drug in development out there. We just got off a call with Scott Gottlieb, the former head of the FDA, and he was highlighting how there are several drugs in development right now that are in clinical trials. He's really excited about the drugs that are biomanufacturing the antibodies that's created by COVID, which should have the very positive results they had. These types of drugs were very effective in treating SARS, MERS, I believe even Ebola. So we should be getting some positive data from those drugs as well in the next few months. So, and then he believes, Scott Gottlieb believes that there should be an approval he's hopeful that there will be an approval of something by the fall. We also had, on the positive front, The number of new cases of COVID in the U.S. are declining, although I'd point out that most of the decline is coming from data out of New York. The decline in New York is offsetting a plateauing of cases elsewhere in the country. The important numbers, I like the New York data because it's been the most consistent and the most reliable relative to other states. And it also, it's the star that has the largest outbreak in the U.S. So it's quite important to the prospects for the U.S. New hospitalizations in New York.
I'll share the slide. Can you guys see this?
Oh, is this going to work?
Ooh, I think so.
This was reported as of yesterday. So new hospitalizations, they're down. What's the number? Down 57% from the peak 18 days ago. This is also the lowest number since March 25th. They also, in addition to this, the number of people in hospitals in New York, that peaked 9 days ago. That's down 17%. Also yesterday, New York had the lowest number of new cases since March 20th. So there's overall the trend is going in the right direction, and we still have in New York, at least in the Northeast, there's probably about 23 more days in lockdown. The governors have said they're not going to reopen the economy before May 15th. So there's if that trend continues for the next 23 days, I think New York is going to be in a very good place. But I would caution that New York is behaving differently than the rest of the country. The rest of the country, we're not seeing these trends yet, but New York was one of the first to implement harsher restrictions on people. One disappointing piece of news in the past week has been the plateauing in the number of tests. And we believe that testing is one of the best solutions to the virus and ways of controlling its spread. But we've, after quickly ramping up to about 1 million tests per week, we've gotten stuck in the last 4 weeks at 1 million tests per week. And part of the package that was approved in the Senate last night will allocate $25 billion towards testing and increasing capacity. But right now there's a shortage in, we have to import a lot of the products that are used in testing, the reagents and the swabs and other things that go into the machines. We have the testing capacity in terms of the machines, but we don't have the reagents to actually conduct the test. But hopefully that will be fixed soon, and some are hopeful that we could double our capacity again to 2 million tests per week. Still not enough to where but it's a big improvement over where we were just 2 months ago with almost no capacity to test. I'll close with this. The biggest news stories of the week are regarding the reopening of the economy. Many of the lockdowns around the country are set to expire next week, and we'll start to see some more news about the plans of how economies will be reopened. I just want to point out that what's going on in Georgia. So there's been formal announcements from Georgia, South Carolina, Tennessee, about how they plan on reopening the economy, or actually reopening it immediately. Governors around the country are meeting and coming up with plans on how to go about doing this, and they're balancing public health with having the maximum economic impact. But in addition to this, there's some political games. So Georgia has made some announcements that they're going to open places like tattoo parlors and massage parlors. These are not don't have a high economic impact, but maybe they're politically favorable in their countries. But I just want to assure you that that's not what's taking place at most of the states around the country. The governors are being very thoughtful about what has the most impact with the least health risk. And we have the advantage in the U.S. We've been watching what's going on very closely in Europe. Europe has already started to reopen their economy. So countries like Denmark, Austria, Switzerland, Germany, they've already started to reopen their economies. And we can look to them to see how their experiences are and to help shape how the U.S. will progress. So many European countries have already started to reopen, starting with small shops, doctors and dentists' office, schools, nursery, daycare centers. But the one thing we've seen from Europe, which I think would be encouraging about what's going to happen in the U.S., is that even though the governments reopen things, it doesn't mean that people return right away. So small stores have reopened, but in most countries, few people are going out to use them. Some are going, but it's not this mad rush for everyone to congregate and crowd in spaces and pass the virus.
Right.
Schools have reopened.
Wait, can I just jump in on one thing on that?
Yeah.
So one thing on that is, so we've been doing these, as Greg mentioned, we've been doing these weekly calls with Scott Gottlieb. I mean, not just us, but participating in conference calls. And the one last week was actually on Thursday. Usually they're on Wednesday just before we do this call with you. And so he was a little late for the call, and he apologized. He said, sorry, I was just on with one of the governors from one of the tri-states. So Gottlieb's working with Connecticut, Maryland, Massachusetts, and New Jersey as a consultant. And one of the things he said there that I thought was interesting is that clearly the rural states will be in a better position to open earlier. The tri-states and the Northeast will be slower. And then he kind of went through how it'll be in stages. So week 1 might be 50% of the people in the office returning. Week 2 might be another 25%. There might be staged where there's like an A team and a B team who returns. And it'll be based on different businesses. A business like ours, where we can be quite distant from each other, we could return more easily than an auto mechanic shop where people are under the car together. So that's the conversation that's clearly being had in this tri-state high density population area. Okay, sorry, Greg. I thought it was interesting.
Yep.
You're back.
So I think the important thing to know is the economy will start to reopen, but very slowly, and then a lot will depend on how people respond to it. Business is not going to return to normal for the next at least few months. But for the economy, I think this April should be the low point in terms of the economy. That May will be better than April as far as the economy goes. And the number of businesses open and the economic activity, but it's going to take some time for the economy to recover.
Yeah.
We're getting earnings that will give us some information about the first quarter, less about April, but just point out one of them that I think was quite insightful was Coke. Coke reported that first quarter earnings were actually fine. They were in line with expectations, was doing well even despite the downturn in late March. But they did point out that in April so far, sales volumes for Coke are down 25% compared to last year. So it just shows how disruptive the virus has been for businesses. Something that as typically has been so defensive and predictable as Coke, even that's down 25%. So it just shows that there's, with the virus, there really is no place to hide, and that even the most stable companies are being impacted.
Right. So with that, we'll bring it back to the portfolio. I know that this week, at least Monday and Tuesday of this week, got off to a kind of rotten performance start, but I need to remind you all that we are digging out, and even if it doesn't feel great, we are on the upswing. I've been working on quarterly reviews, and I'm sorry that I'm as slow as I am with them. It's a little more challenging than I thought to write in a personal note for each one and get into the details. But it's interesting because as I'm doing them and comparing just 3/31 data to today, there is meaningful improvement as I'm sending them out versus what was reported just 3 weeks ago. So that's positive. On average, the U.S. income portfolio is up about 4% since the end of March. I think the thing to remember, and I keep reminding myself of this too, is it really does seem like a 3 steps forward, 2 steps back, 3 steps forward, 2 steps back kind of recovery process. There has been a ton of information and news in the portfolio this week, and frankly, since last Wednesday. And frankly, there's been more good news than bad news so far. The highlights are Qualcomm actually increased their dividend by 5%. IBM reported earnings yesterday, and on the conference call, the CEO and CFO could not possibly have been stronger or more forceful in their commitment to ability to pay, protection of the dividend. Usually this is a side note on these kinds of calls where they just say, oh yeah, and the dividend is blah. But what I think is interesting is as dividends have been kind of under attack by the public, they're becoming more precious. And the companies that can pay them and intend to pay them know that, and they're being more purposeful in their language around it. So that was encouraging. AT&T reported earnings this morning. Just to give you an idea, the expectations were for AT&T to report 85 cents a share of earnings. They reported 84 cents. Not so bad. They had the same level of forcefulness surrounding the conversation about the dividend that IBM did. It was very encouraging and very reassuring. An interesting, unrelated to the investment part of this, but a very interesting thing that was discussed on the AT&T call, the CEO was discussing this, and it was in response to one of the questions that someone listening asked, which was about, how are you thinking about the future? How are you trying to lay out your roadmap for going forward? And what AT&T said was, look, we have the resources to access the best economists in the entire world. And that's exactly what we've done. We've called in, we've paid whatever they need to pay, the best economists in the whole world to help us try to think forward and look through various different scenarios that might come out of this. And then this is the great part. And they're like, and you know what? You take 12 economists and you have 12 completely different expectations for the future. And I think that's important for us to remember, that I'm not going to get this exactly right. Greg's not going to. No one on this call is. Even the best economists in the whole world aren't going to nail what the right outcome of this is to precision. So what we do is we take the information that we have today, we act as rationally, calmly, patiently, reasonably as possible, and just keep putting one foot in front of the other, and know that in the end, we're going to make more decent decisions than not, and we're going to come out okay. A couple more companies, Navient reported earnings this morning too. They actually had decent earnings also. And this was really interesting. On the call, they did affirm the dividend, but it wasn't super strong language. So I followed up with them immediately afterwards. And I said I was really surprised that you didn't beat the drum on your ability to pay the dividend without blinking. Why weren't you much stronger on that? And they said, oh, Jenny, be aware, which I should have been aware of this before. It just slipped my mind, is this is a company that does student loan processing. And they're like, there are huge optics to us beating the drum on that, given what the environment is. And I was like, oh, of course. And they said, but there is no problem and no risk to the dividend. So you do not need to worry about that. It doesn't even need to be belabored on the call, because that dividend is so safe and well protected by their cash flows. In fact, for that company, the dividend is 64 cents a share. This quarter alone, they earned 51 cents a share. So there's really no problem there. On Compass Diversified, which we have in our portfolios and have chatted about a bunch, there's a hugely positive mention on it in Barron's over the weekend. The stock was up a lot. Okay, those are the highlights. The low light since we last spoke. So just going back to when we started this, and we started talking about how we'd segmented the portfolio. We had, this part of the portfolio we have no worries about. This part, if things extend for a much longer time, longer than we expected, there will be trouble, or there could be trouble. And then these companies we know we need to get rid of. So when I let off the call and I said, we were talking 6 calls ago about 2 weeks, 4 weeks, 8 weeks, and now we know it's longer than 8 weeks. That's where some of these companies that were in the, if it extends for a lot longer, there could be trouble. One of them has already come out of that and has gone into the we're fine category. And then last Friday, Schlumberger, which does it's an energy related company. Too hard to describe what they do, but if you want me to give you a better explanation offline, I can. But Schlumberger on Friday did in fact decrease their dividend by 75%. The market actually had a very positive response to the overall earnings for the quarter. The stock was up strongly, and we pounced on that, took advantage of it, and got out of our position in Schlumberger. So actually just maybe an hour ago, we started to redeploy some of the proceeds from that. It seemed like Friday was a really frothy day. And so I've been trying to use limits to sell things at higher prices and then wait patiently, knowing that there will be volatility. So just today, we started to pick away at a few existing positions and adding to those. And those included Sabra, ONEOK, Energy Transfer, and actually Navient after the great call this morning. So that's really it for current updates in the dividend income portfolio. Just know that I'm working super hard to continue to transition it out of the companies that have underperformed, I think will continue to underperform, and into companies that will do better. I expect within the next week or two, maybe 3, we might add 1 or 2 actually new positions to the portfolio that we've been working hard on. So that will be exciting. I know that it bugs the daylights out of some of you that I haven't sold Six Flags or Ryman yet. Please be patient with me on those. You know that I believe that they should trade a lot higher. Last week, a couple of analyst reports came out. One gave Six Flags a $23 price target, another gave Ryman a $55 price target. These are well above where they're trading now, and I think they're accurate. So I want to be strategic about those sales. So be patient, but rest assured, we are getting out of the underperformers and reinvesting in companies where we know the dividend's safe and we should see significant outperformance too. So that's it for me right now. I'm going to turn it over to Greg for a few updates, and then we will open it up to questions.
Yeah, and we've been relatively quieter compared to the equity income portfolio. The international, we've had only three companies have reported earnings so far. We had all three were really good. So Roche, Taiwan Semiconductor, both were ahead of expectations. And China Mobile had good earnings numbers, reported growth. And when you think about what was going on in China during the first quarter, they essentially had the whole country on lockdown in February, on a much more severe lockdown than we have here in the United States, and yet still a mobile telecom company could actually perform well in that environment is quite amazing. So they reported growth, and the stock has responded very well. In the growth portfolio, we've again quiet on earnings. Only 2 companies have reported so far, but I think the highlight of the 2 is Thermo Fisher, which we had just bought 3 weeks ago. This is one of the largest healthcare equipment providers, but in the first quarter, even with the disruption in March, they reported earnings that were up 5%. So they're off to a good start to the year. They can't produce guidance for the full year because they don't know what's going to happen, but they seem to be optimistic. The stock is up about 21% since we bought it. So I think it just goes to show that there are really good opportunities out there, and we're just going to try and stay nimble to take advantage of them as they present themselves.
Yeah. So with that, I'll wrap it up, and I'll just say that, again, with the thought of 3 steps forward, 2 steps back, I do want to remind everybody that we have not revisited. And I think that this is important because things aren't, we had a lot of enthusiasm, a lot of move up, and then it's kind of tapered off, but we have not revisited the lows that our portfolio set. Oh shoot, hold on, I need to pin my video. That our portfolio set on March 18th, and that the broader market set on March 23rd. And I don't think we're going to revisit those. Over the past decade, since the financial crisis, we've become very accustomed to severe market pullbacks and then sharp returns. And sharp returns that not only got us back to where we were, but then eclipsed the highs that we've been made. I think right now it's important to adjust our mindsets, realize that this recovery is going to be slower. It's going to be, again, 3 steps. I know I'm being annoying with saying it so much. Sorry. 3 steps forward, 2 steps back. It's just going to be a slower recovery, but we're going to get there. And the more I think about it is, if I didn't know that and believe that we will get back to where we were, and if we don't get past our highs, I'd be a fool. Because all market history, 100 plus years of market history, tells you that that's exactly what happens. Sometimes it takes 2 months, sometimes it takes 2 years, but every past crisis or disaster or market decline has ultimately driven the market up and forward and higher. So I think that's okay. John does not want me to say this, but I'm saying it anyway. John reminded me that Tom Petty's lyrics are "waiting is the hardest part." And I think that's certainly true for me. Waiting to get back to those past highs is definitely the hardest part for me. But I know that we'll be okay, and I just need to muster my own patience and hope that you all do that too. So with that, we will open it up to questions. I know I say this every time, but everyone has slightly different portfolios based on asset allocations, timing of when you joined, all of that. So please, keep the questions high level, and if you have specific portfolio questions, don't hesitate to follow up specifically. And I think what I'll do is, rather than unmute everybody, please just unmute yourself by, you can click on the little, if you're logged in, you can click on the little microphone icon, or if you've dialed in, you can press *6. But please ask questions, because if you don't, I'll fabricate them. Anyone have questions? Tracy?
So Jenny.
Yes.
Can you hear me?
Yes, this is my mom, you guys. Yes, Mom?
So this is not a stock question. This is just something I heard right before I dialed in. I was listening to Cuomo, and this may be public knowledge now. I had just heard it. But apparently Bloomberg, in partnership with Johns Hopkins, is going to arrange for testing and pay for it and fund it for all of New York, and it will be coordinated with New Jersey and Connecticut. This, to me, since testing seems to be the essential piece of starting to get out of this, is incredibly good news. And if it's done well, and I assume it will be, it may be a model for other states. So anyway, that's some good news.
Yeah. Greg, do you want to respond to that?
I was listening to that call as well. The testing that'll be on the Bloomberg's going to head up the testing on the antibodies testing. So that's testing not to see if you have COVID currently. It's to see if you've had it in the past, and then you've established some immunity and have the antibodies in you. The one caveat on those tests, though, as Scott Gottlieb was talking about on the conference call we were listening to before, is that there's a high level of false positives on those tests. So the usefulness of the test tends to be for just surveying how many people were infected with the virus, as opposed to giving people a free pass to go out and if you have a false positive and you go out believing you can't behave poorly and not practice social distancing as a result of the test. But
Right.
this is the proper response to the virus is through science and more testing and more tracing. That's the way to attack the virus.
Right.
Yeah,
And what Gottlieb said.
And a pardon?
No, go ahead.
I just was saying in a coordinated effort, regardless of how it starts or what they're testing right now, at least is a good model to go from. I'm going to sign off.
Okay. What Gottlieb said, because I do think this was really interesting too, was that the antibody tests that I think you can actually get home tests. He said that is not the hall pass to go back to work, because to Greg's point, they have tremendous wrong data. And so he said it doesn't work at the individual level, but it does work at the population level, because he said because the scientists who study those, so Hopkins, they know how to correct for the fact that X% deliver wrong data. So they can make a population-based judgment on it, but you can't make individual-based judgments on it. One of the other things on testing to get people back to work, but not just the antibody testing, he was saying by May, there should be 2 million tests a week, by June, 3 million, and that there should be truly sufficient testing available by October. Okay, who else has questions? Oh, Mrs. Canvas. Okay, hold on.
Greg
Okay,
mentioned,
you are unmuted. Ask away, please.
mute, wait,
No, I can hear you.
oh, you can. Greg mentioned Coke before. You mentioned the oils and how depressed they are. And I'm wondering, do you ever, do any of these be considered knowing that they are low and that their dividends are good?
So we already have significant exposure to the energy companies that are depressed,
Right.
and have really strong dividend yields that they've publicly stood behind, that we can see that they have the cash flow, even if things get worse, that they have the cash flow to support.
Right.
So those were, yeah, in fact, I added 2 of them, and again, it depends on how much you already had. So I brought 2 of them up to full position size this morning. So that's exciting. Coke, we don't own in either of our portfolios,
Right.
and haven't. And that has more to do with like long-term growth trends for that. The yield, I don't remember what the yield on Coke is, but it's not.
I just looked it up. The yield
It
is
is good.
3.7%.
Oh, so it has crept up with it coming
So
down.
it's
Yeah.
probably too low for you still, and not enough growth for the growth portfolio
Right.
at this
I see.
point. But
So that's how you calculate it.
Right. So it's, it needs to have either enough growth or enough yield. And we have a lot of these that fall into this kind of no man's land. We were talking about CVS last week, which is another one that's fallen into the no man's land of not quite enough growth, not quite enough yield.
Yeah.
But thank you.
Thank you.
Okay, who else might have a question? Oh, you can email me if you're feeling shy. You're welcome to email. No email questions. Okay. Well, then I'll say going once, going twice. Thank you all so much for joining us. Steve has one. Hold on. Okay, Steve, you are unmuted.
I was just waving goodbye. That's all. Let's say goodbye.
Oh, okay. Bye. Have a good day, everyone. Thanks for sticking with us. Thanks for hanging in there. We'll see you all again next week, same place, same time, as long as you want to keep playing along. With the rate that earnings are coming out, we'll probably have lots to talk about.